Hey everyone, welcome back to Corporate Decoder today. AVK Advent Convertible and Income Fund just filed its semi-annual report, and I'm seeing a few areas that really tell a story about their strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a really clear look at how their unique blend of investments performed during a specific 6-month period, revealing both strengths and potential areas of caution. So let's dive into what the Advent Convertible and Income Fund, or AVK, has been up to this form. N-CSR is essentially a certified report they submit to the US Securities and Exchange Commission, ensuring they are transparent with their shareholders about their financial health and operations. We are looking at the 6 months ending the 30th of April 2026. This gives us a snapshot of their performance during that time. The fund manager, Tracy V. Maitland, puts it bluntly: they thank you for your investment and highlight the fund's objective to provide total return through capital appreciation and current income. This means they are aiming to grow your money and also provide you with regular income payments. Now, here is a key number to focus on for this period. They saw a total return based on market price of 1.82%, but a much higher return based on their net asset value, or NAV, of 6.24%. This big difference between market price return and NAV return often signals that the fund's shares were trading at a discount, meaning you could potentially buy in at a lower price than what the underlying assets are actually worth. And that discount is pretty clear here. Their market price was $12.50 per S-share, but the actual value of the assets that share represents the net asset value was higher at $13.47. That is a discount of over 7%, which can be attractive for investors looking to buy into funds trading below their intrinsic value. It is always important to remember that past performance doesn't guarantee future results, and these returns they quote for NAV all their management fees and other expenses deducted. They also managed to pay a consistent monthly distribution of about 11.5 cents per share. This is a significant part of their income objective. The economic backdrop for this period sounds like a mixed bag. The US economy was described as reasonably robust. Despite ongoing government budget issues, the Middle East hostilities were a concern for inflation and consumer spending. But surprisingly, investments in artificial intelligence, or AI spending, really helped boost us corpa. Rate profits and overall economic output, this AI boom seems to be a major driver benefiting multiple industries. However, inflation fears caused yield curves to steepen. This means long-term borrowing costs went up, which can be a headwind for investments like bonds. Interestingly, their core investment area, convertible securities, saw high issuance. This means companies were actively using convertibles to raise money, likely because they offer a way to get capital now, with a potential equity upside later. Now let's dig into how the fund actually performed. Tracy Maitland and his team explained that for this 6-month period, the market price return was 1.82%, while the NAV return was 6.24%. Again, that bigger NAV return is the key story here, indicating a strong underlying performance that wasn't fully reflected in the share price. They also compare their performance to major indices, and this is where it ggets interesting. The ICE-BOFA US Convertible Index, the main benchmark for what they invest, returned a very strong 13.28%. This significantly outperformed other indices. The S&P 500, which represents the broader US stock market, returned 6.03%, and the Bloomberg US Aggregate Bond Index, a key bond benchmark, only returned a modest 0.54%. The managers point to the strong performance of convertible securities, particularly domestic ones, as the main contributor. They explain that these companies are often involved in growth trends like AI and government initiatives in areas like nuclear power and defense. This focus on growth industries helped them navigate the risks from inflation fears tied to Middle East hostilities. Even though the Federal Reserve was lowering short-term rates, interest rates on longer-term loans actually went up. This is a bit unusual, but they explain it was driven by inflation concerns and government borrowing needs. A big advantage for convertibles here is their shorter average maturity compared to other fixed income investments. This means they were less hurt by those rising long-term rates. They mention using covered call options to generate income, but have restrained this strategy to capture more equity upside volatility in the options market, such as the VIX index averaged around 18.9 this period. And while it was on the rise, they are more focused on their core holdings. Leverage is a significant part of their strategy. They maintained $350 million in leverage. That's about 37% of their managed assets. This leverage was helpful because the return on their investments exceeded the cost of borrowing. Looking at their portfolio breakdown, close to 52% was in convertible bonds and related instruments, about 34% in corporate bonds, and 8.7% in equities. They've increased their allocation to convertibles and equities during this period. The top performers in their portfolio were heavily tied to AI investments. things like optical components, suppliers, disk drive makers, and semiconductor companies. These businesses benefited from the ongoing build-out of data centers and AI infrastructure. On the flip side, investments related to digital currencies took a hit. Cryptocurrencies saw a pullback after a strong inflow earlier in the year, which hurt convertibles tied to companies like Coinbase and Nvidia. The sluggishness in Chinese companies like Alibaba also detracted from performance. The schedule of investments is a deep dive into their holdings. Here we see many familiar names across different sectors, like Royal Caribbean, Cummins, General Motors, Alphabet, and Nvidia. They are also holding significant amounts in convertible preferred stocks and convertible bonds from tech, industrial, and utility companies. Their largest holdings are clearly in convertible bonds, making up over 70% of the portfolio. This reinforces their strategy of focusing heavily on this asset class. In their statement of assets and liabilities, we see that total assets were over $965 million liabilities, including reverse repurchase agreements, and borrowings were around $371 million. This leads to net assets of about $594 million. They have a significant amount in reverse repurchase agreements, which is a form of short-term borrowing to boost returns. And they also have substantial borrowed funds from their credit agreement, totaling nearly $158 million. The net asset value per S-share at the end of the period was $13.47. Looking at their statement of operations for the 6 months, they generated over $22 million in investment income. Mainly from interest and dividends. Expenses, including interest on their borrowings, were around $12.2 million. This resulted in net investment income of just over $10 million. Crucially, they had a very strong net realized gain of nearly $27.5 million from selling investments. This really boosted their overall results. However, they did see a slight unrealized loss around $1.7 million on their investments as the market value changed by the end of the period. The overall increase in net assets from their operations for the 6 months was over $34 million. The financial highlights table gives a great overview of performance over several years. We see the NAV per S-share ending at $13.47 for this period. Their NAV total return for these 6 months was 6.24% as mentioned earlier. And the market value total return was 1.82%, reinforcing that discount we saw earlier. Their net expenses, excluding interest expenses, were about 1.47% of average net assets, which is quite reasonable. The portfolio turnover rate was 90% for this period. This means they bought and sold about 90% of their portfolio, which is active but not excessively high for this type of fund. Their total borrowings were significant at $158 million, and their asset coverage per $1,000 of debt was a healthy $4,763, which shows they had many assets covering their borrowings. The notes to the financial statements are crucial for understanding the policies they follow. For example, their valuation of investments follows strict guidelines to ensure fair value, and they clearly detail how they handle foreign currency translation and derivatives like forward foreign currency exchange contracts. Now let's talk about the risks involved. The filing dedicates significant space to what they call principal risks. This is where they warn investors about what could go wrong. The first is investment and market risk, the fundamental risk that the value of their investments could drop due to broad economic or market conditions or even specific company problems. This is especially true in today's volatile environment. Then there is the market discount risk specific to closed. And funds like this one, their shares can trade below the actual value of their assets, the NAV, and there is no guarantee they will ever trade at par or above the purchase price. Convertible securities themselves have a specific risk. They're a hybrid between bonds and stocks, so they are influenced by both interest rate movements and stock market fluctuations. A big part of their strategy involves investing in lower grade or junk bonds. This means a higher potential for return, but also a substantially higher risk of default if the companies they invest in run into financial trouble. They also highlight leverage risk. Using borrowed money magnifies both potential gains and potential losses. This means when the market moves a small amount, the impact on their net asset value can be much larger. Finally, they acknowledge a critical modern risk: cybersecurity breaches. This can affect not just them, but also their service providers, issuers in their portfolio, and trading counterparties, leading to data loss, operational disruption, and financial losses. Advent Capital Management LLC, the investment advisor, emphasizes their bottom up security selection process, looking for attractive risk reward and favorable cash flows. They screen the markets, analyze quality, and monitor fundamentals constantly. In a nutshell, AVK navigated a complex period with solid underlying performance as shown by the NAV growth, but a persistent discount in their market price presents both a risk and an opportunity for savvy. In investors their heavy reliance on convertible securities, especially those with exposure to growth trends like AI, was a major contributor, while leverage and lower grade bonds add to the potential for higher returns. They also dial up the overall risk profile. Investors need to be aware of the significant market and the specific risks associated with their investment choices, like the convertible bell and junk bond markets, especially given the current economic uncertainties and cyber threats. That is my take. Stay decoded.